the channel and to a new edition of 5-Minute Finance. This video today is for all of my self-employed people out there. Before we get started though, if this is your first time at our channel or if you haven't done so, please like and subscribe below. Now, welcome back to my self-employed people. Today we are talking solo 401k. This is an amazing tool if you are truly self-employed, meaning if it is just you or you have a spouse that you have a business with. If you have any other, even just one other full-time employee, unfortunately you can't set up this solo K. But as we'll see, it is an amazing tool. Okay, what is the solo K? It's really easy and cheap to get started. You do an account with your online broker, Schwab, TD, whatever. You do an employer adoption agreement, set up some details and parameters, and that's it. You kind of really just get rolling. So the way it works is, as the employee, you have a salary deferral. You put in every paycheck, however you pay yourself, you put in a piece of that as the salary deferral, and you can put in up to $19,500 for the year with a $6,500 catch-up contribution if you're over the age of 50. Now, the secret sauce to this is the profit share piece. So the profit share depends on how you have your business structured. There's two different formulas. If you take Schedule C, self-employment income, you can contribute a profit share contribution up to 20% of your net adjusted business self-employment income. You can also, if you pay yourself a W-2 wage, you can contribute a profit share up to 25% of your W-2 compensation in that year. So let's use an example. Let's say you pay yourself, your business pays you pay you $100,000 in W-2 wages. Well, throughout the year, you've done your salary deferrals and you've maxed out your contribution of $19,500. Now you can do your profit share as the employer to you, the employee, 25% of your W-2 comp, which was $100,000, which equals $25,000. So now you've got $25,000 profit share, $19,500 employee deferral, and match them together. A hugely important and powerful strategy to do if you can make this work. Now, obviously, your cash flows have to support it, your profitability. Maybe you're wildly successful and you can do this, or maybe you have a spouse that has a full-time job to cover your monthly cash flows and your lifestyle expenses. So again, this is an amazing tool if you have the opportunity to sock away vast sums of pre-tax retirement dollars for yourself. A lot of people ask me, well, Steve, the SEP IRA, I've heard a lot about that. I'm self-employed. Yes, the SEP IRA is an extremely popular plan for self-employed individuals. But what people don't know about is the two contribution elements of the solo K. In the SEP IRA, you are only doing that profit share piece. So as the employer, you're contributing just that profit share. So in our previous example, let's say you are taking Schedule C self-employment income and it's 20%. So at the end of any given year, you have a very profitable business and your net adjusted self-employment income is $100,000. Well, you can contribute 20% of that $100,000 or $20,000. That's wonderful. Great. I mean, it is great. But if you, as that same person with that same business, had a solo K, you can do the salary deferral up to the annual max of $19,500. Now your net adjusted income, business self-employment income, is $100,000. You can do 20% of that $100,000. So that's $20,000 plus your $19,500. So again, you can see the SEP is great. It's a really cool tool, but the solo K, as far as being able to put away these retirement dollars, really blows it out of the water. Again, that's assuming you fit the criteria of that self-employed individual to establish the solo K. These plans, as I mentioned earlier, are really cheap and easy to get started. If you have any questions, please send us an email to the Contact Us link below. You can always drop us a comment as well. Thank you guys all for your time today. Stay tuned for the next episode.